Wonderful. Thank you so much for joining me. I'm excited to kick off this awesome event. I will spend a lot of time actually not talking about DeFi. I'll end on DeFi, and I think that's fairly important. So I'm going to spend a lot of time not talking about DeFi because I think for DeFi to work, it's really the context that you have to understand. And so my job is to set the macro context for what finance is, what financial services is, how it's ramped up to this point. And I think the rest of the conference, you're going to start getting into the actual kind of how does the engine of the thing work, how do you connect the plumbing. And so the point of the journey is going to say, why are we primed for this exponential growth in software financial assets? What is going on? So bear with me. There is a conclusion, but there's also a journey. Okay. So we'll talk about first, a bunch of you already know who I am, but I'll give a little bit of intro why it makes sense for me to talk about this topic. Then we'll set out financial services broadly and anchor it to where finance is in an economy. Then we'll talk about FinTech progress to date, and it tickles my bones that FinTech is traditional and old, but I guess time moves on. So we'll talk a little bit about what FinTech has gotten done and what it has not gotten done, and what the opportunity is for manufacturing financial instruments using blockchain-based networks. And then we're going to land on a little bit of science fiction. Great. So super quick, I'm Lex. I was a FinTech entrepreneur building out a robo-advisor, spent 6 years doing that in New York. Then I spent 3 years building out Autonomous Next, which is a research firm for institutional investors, and we focused on blockchain and artificial intelligence and neobanks, robos, and crypto. Matt Lowe, hand up. Matt continues to bear the torch of Autonomous. Subscribe to the newsletter. And then just recently, I joined ConsenSys to help organize and package activity around digital assets, financial blockchains, decentralized finance, and figure out how all of that works together for ConsenSys as a whole and help the ecosystem grow around it as well. These are screenshots from software. They prove my point. That's a joke. You can relax into the joke. It's fine. Okay. Coffee is necessary. Financial services in context. There's been a shift in how our economies are structured. You know this shift. It's a shift from industry to services, entertainment, finance, professional services, human work rather than industrial objects. So what this chart shows you is how GDP for the United States has broken down by industry over time. And so I want to anchor the blue line, right? The blue line that's going up, the red line is going down. The blue line is financial services as percent of GDP, going from under 10% to somewhere around 20% of an economy. Manufacturing down, other pieces down as well, right? And then the green line, professional and business services. So I want you to have in your mind this line, kind of around 15 to 20% of an economy is finance. And that's fairly recent. You know, as machines take the work that we do more human work, and finance is more human work. And this has also happened across multiple economies, right? This is not just an American thing. This happened across essentially the developed world. So it's a black and white chart. It's from an academic paper. So apologies, but maybe you'll see my blue highlight. The manufacturing percent of GDP is going down. It's not highlighted. And then the highlighted line is percent of GDP in financial services going up. And you can see a bunch of different countries. So it falls somewhere between 15 to 25% of an economy. Right? That's where we want it to be. Finance is important. And it's important because it's one of the pillars that structurally makes a society full of human flourishing and wealth and productive economy. And so what this regression shows is, on the one hand, you have the percent of the population which has access to credit cards. So 15-year-olds and up that have access to banking and financial services across the world by country. And then the other dimension is GDP per capita, right? So the correlation between having a high GDP per capita, high standard of living, and access to financial services, having access to finance, is very high, right? So my R-squared is 0.8. Somebody can school me about correlation, not causation. You can run this against penetration of banking services. You can run this against exchanges, equity market participation, insurance, whatever you want. You essentially get the same outcome, which is when people have access to financial products, they're able to build economies, flourish, build businesses, and improve the community as a whole. As an aside, giving financial services to women is actually a lot better than giving financial services to men. So if you are either Bill or Melinda Gates, that's advice for you. No? Nobody here is Bill or Melinda? Okay. That's the slow clap. I interpret that positively because I have a reality distortion field around me. Okay, so of course, finance can go bad. I don't need to put pictures of Lehman Brothers on the screen or the various CEOs of Goldman Sachs. It's not an indictment. I actually worked at Lehman Brothers, and my formative experience in finance at Wall Street was 2008. I got that education early on. And I think a lot of people, especially in DeFi and crypto, have you say Wall Street, I say bad kind of thing going on, which is fair, but also, if we take a step back, there is something to say about choices. So it's nothing inherent about financial services, which is an empowering industry, that creates wealth inequality or that creates rent-seeking, or you just happen to be closer to the source of the water, which in this case is money. Rather, the inequality and the Gini coefficient issues and all that stuff comes from social choices. So what I have on the page here on both the left and the right is the percent income going to the top 1%, to the wealthiest earners. You can do the same thing for wealth or capital ownership, things like that. And you can see it over time, right? So on the left, you have a lot of English-speaking countries which come with their own social structures. And so you see from the 1900s, top earners getting around 20% of all the income out there. Then that dips, and then it dips back up, right? So as we kind of enjoy neoliberalism, you have more accrual of wealth in a more unequal way. On the other side, you have European countries and Japan, and I think Norway's in there. Norway's holding the fort. And you don't have this issue, right? You still have the same financial pillars, but the question of who gets what and is it unequal is a social question. It's a structural question. It is not a question of whether we should have finance or access to financial services. And I kind of want to just anchor that. So governance matters, right? This is actually a great slide for governance matters. It matters if you have inequality or not. So all of this to say, right, 20% of GDP, finance is an empowering thing. All of this to say of where are we today? And this chart is extremely powerful. It's kind of mind-blowing to me. I find charts mind-blowing because that's who I am. And I hope you find this one interesting too. The blue bar is venture capital funding. So there's one broad shift, which is that the public markets are slowly being replaced by the private markets. Uber, WeWork, they're raising lots of private capital. They don't want to go public at a $150 million valuation. They have plenty of runway, right? SoftBank will do the good deed of continuing the journeys of these companies, continue to subsidize taxi rides. So you have a pretty intense, I think, 5x rise in a shift from public funding to private funding. Number two is the black bar. So the black bar is the percent of venture that is in FinTech. So in 2010, about 5% of venture was in FinTech, and today it's at 17%. So if you do the math out, from 2010, it's something like $2 billion in FinTech venture funding to about $40 billion today, right? So you could not have a more supportive environment for FinTech companies because both the private shift is helping and the shift into FinTech is helping, right? So today, again, anchored to the GDP number, somewhere around 10 or 20% of an economy, we've actually reached that level in terms of private fintech participation in the venture industry. The final piece, which is interesting, again, to me, because I'm that kind of person, is the blue bar, which is the percent of public companies in finance. So you can actually see that as part of the World Index, financial services firms are decreasing, right? So again, you have this sort of bleed out into the private fintech world. And so a lot of these trends are putting us in a moment today where we're equilibrated to the right amount of funding, to the right place in our industry, and have a lot of backing behind us. Any questions? Just kidding. There's no questions. We don't take questions. These are all pronouncements. You can't question pronouncements. Okay. So this is the story, right? The story is all the good stuff is happening. Finance is important and empowering. We're equilibrated to the GDP level of financing. We're doing good work. What have we done? Let's look at traditional fintech, as you call it. So in traditional fintech, you have a whole bunch of symptoms. All these symptoms look the same. Who's a VC in the room? There you go. For all the entrepreneurs, selfies. So for the VCs in the room, it's a frustrating journey because every year there's a new word, right? There's robo-advisors and neobanks and insurtech, and then it's artificial intelligence, and then it's chatbots, and now it's cryptocurrencies, but it's not cryptocurrencies anymore. It's distributed ledger technology, and now it's smart contracts, and then it's DAOs, and then it's DeFi, right? So like the thing moves all the time. And the important thing to understand is that it's actually all the same stuff. Like it's not a whole bunch of different disparate symptoms. Source autonomous next. It's not a whole bunch of different symptoms. It is one thing, which is just the digitization of our society. Right? So the digitization of our society happened to music and to retail, and it's happening to healthcare and government, and it's happening to finance, and that's it. So there's nothing particularly different or special about it. And so one framework to think about it is really boil it down to what it is. So people have trouble with finance because it sounds complicated. If you boil it down, end of the day, it's like any other industry. The back of the house is a factory, and in the factory, you make stuff, right? So it's manufacturing. The front of the house is a store. In the store, you sell stuff. It's distribution. Between the store and the factory, there's a bunch of glue that connects it together. It's middleware, middle office, value chain, whatever you want to call it. That's it. You make investment funds in the factory, you sell it with financial advisors. You underwrite insurance in a carrier, you sell it through insurance salespeople. You create a DeFi lending protocol in the factory, you sell it through Instadap. It's the same way you would buy an Apple, nothing special. And so the other dimension to think about is the digitization sort of vector, how it's happening. Different types of automation, and I'm reductive in this mental model. In my mind, there's kind of two key ones. One is taking human-based process and writing it into software, so human process to machine process. And then there's another one which is taking human intelligence or the judgment around stuff, and you go from human intelligence to machine intelligence, right? And so you can have automation of account opening. That's going to be your, it's your bingo. So automation of account opening is middle office, human process to machine process, et cetera, et cetera. Okay. So that explains how all the fintechs come together, and you can draw lessons across industries for this stuff. And where we are today is that over the last decade, fintech vertical champions have created companies in lending, SoFi, in banking, Revolut, in payments, Venmo, in wealth management, Betterment, or Scalable, or Nutmeg, in savings, micro savings, Acorns, in trading, Robinhood. And they've gotten their billion-dollar valuations, and now they have trouble with profitability. So what they do to deal with that is they go into adjacent sectors. So SoFi used to be a lender, but now they're a wealth manager and an insurer. Betterment used to be a wealth manager only, but now they've got a bank account. Same thing for Revolut, right? It's for FX money movement, and now it's also for trading crypto. Large banks are copying the playbook. They're doing exactly the same thing. And they're price competing, right? So JP Morgan has a Robinhood clone. Schwab is offering free robo-advice. What else have I got? Merrill Lynch. So Merrill Lynch used to be this high-end wealth management brand, which now, of course, has its own robo-advisor and also is teaching people to open bank accounts on behalf of their clients. So you've got this convergence with the fintechs, which is reverberating with a convergence with the big banks, which is reverberating down the line with big tech firms. Will Amazon enter finance? If you're asking that question in 2019, you should be fired. It's a dumb question. They're in finance. They've got 10 products in finance today, right? Will Apple enter finance? Again, dumb question. They're in finance. So the point is, there's one answer for what the sort of fintech future experience looks like, and everybody is converging to try and build it together. And the impact of that, when everybody is starting to attack the same customer space, is price compression. So you used to pay 150 basis points for wealth management. Now you pay 25. We're still in the boring fintech land, right? Like, we're not even in crypto. So you pay now 25. That's a 70% decline. You used to pay, that's fair. The other example is TransferWise or Revolut for money movement, right? So you used to pay 6% to move $1,000 from the UK to US, or if you go from London to Paris and you buy a sandwich, you're going to pay a 6% tax to your bank, 3% on FX spread, 3% on fees, right? So that has gone down to zero essentially as well because of companies like Revolut, Monzo, and others. This we'll skip. So this pricing compression is happening across industries, and the different companies are participating across the different products. And so what I want to do is create an organization for you of these different industries and products and how they fit together and how things overlap. So this mental model is about customer behavior. I need a coffee because there's like a lot of things on that chart. The key thing is this arrow that says more frequent or very rare. More frequent interactions are things like information exchange. So when you go in that Telegram group and you chat with people, that's happening all the time. That's very frequent. It's a low-value transaction. But anytime you give information, that's value. Now, let's say instead of giving information, you give money. That is a transfer of something that's a little bit more valuable, at least today. And it's a little bit less frequent, right? So you have apps that deal with money transfer. So then out of money transfer and payments, you have money at rest. The money stops moving. It has to sit somewhere and accrue. And it accrues interest, and you can lend it, and you can borrow it, right? So then you get to banking. And out of banking and lending, maybe you now have enough of a pool that you start thinking further ahead. You start thinking not just, what am I going to spend on toilet paper next month, or diapers, which is my primary concern. Not for myself. But maybe. But no. But maybe. Okay. No. So you shift to, let me invest for the next 3 months. Let me invest for my goals. I want to save up for a house. I have a kid. I need to save up for college. So you get into wealth management. And then from there, you start getting into insurance, right? You need life insurance once. Or you need home insurance 4 times. Or car insurance 20 times, whatever it is. So you become less and less frequent, and the sizes of things grow. So for me, this is not separate, different, distinct products. This is a continuum of value transfer, more capital all on the right, more communication information on the left, and naturally there's a bleed between these industries, which is why it's not surprising to see Telegram trying to get into their own token. It's not just opportunistic, it's this concept. It's not surprising to see financial services providers trying to integrate into messaging apps and marry all this stuff together because it is just a natural continuum. And so to belabor the point, I thought this was actually surprising. I got the mobile app screenshots of different companies, right, starting at Facebook and ending on Aviva, which is an insurance site. And they all are adjacent. Like if you stack them together, they all interlock. They all have a continuum. Everyone who does investments does banking. Everyone who does lending does money movement, and so on. Of course, this is really old hat. Is that an expression people use? This is really boring and conservative if you're in Asia, where obviously this all lives together in a single super app, which has banking and lending and payments and insurance and toilet paper and diapers and movies and so on, right? This is what Amazon and Facebook want to be, and this is why they're in banking. Because super apps have, nope, don't have it. Super apps have 800 million customers. I did the math the other day, right? So if you look at Ant Financial, it's like 20 Revoluts put together. Right? So if you take all the American and Western fintechs and glue them together, less users than Ant Financial. So that's the advantage of being a super app. And the final framework to kind of understand what has happened to fintech and financial services is to understand that it's turned orthogonally 90 degrees away from how it used to be. I mentioned that you start with a factory, you've got a product manufacturer, you make the thing, right? I'm Barclays and I make a bank account, I'm going to sell it to you through a branch, etc. And now what you've shifted towards are platforms, whether they are blockchain-based platforms or whether it is Amazon or Ant or any other. And the platform really is in the business of sucking in your attention, right? It gives you dopamine and it steals your attention, and that's your trade all the time, right? It gives you notifications and then withdrawal symptoms, and that's how it is. So that's your attention platform, and in it there are thousands of features. There's entertainment, there's food, there's clothes, and there's finance. And finance is just one feature inside of that, right? So that is a very big pivot in terms of how the financial industry is structured. Not manufacturing-centric, but customer-centric. Obvious, but very difficult for a lot of people in finance. Okay. I'm like coasting on my coffee high. Like now it's like the good part. I'm stable. I'm not ramping up anymore. Okay. So let's talk about why it doesn't feel important. Like, I spent time building fintech companies, and I spent a lot of time analyzing fintech companies. And like, there's a bunch of apps in an app store, and that's what it is. And Barclays is still there, and Deutsche Bank is still there, and Goldman Sachs and JP Morgan are going to be the winners of a lot of fintech. So why doesn't it feel fundamental? And this is my answer. This is what I've come to as the answer. And it's really straightforward, which is manufacturing. We're manufacturing the same old stuff, right? If you're Revolut or Robinhood, you're using the same core processing system from banking or the same wealth management system, or you're using the same payments rails. You're using the same, you're distributing digitally a manufactured product which is the same old. And if you look at any large platform shifts over the last 20 years, that is not what happened, right? If you want the Uber or the Google or the Netflix, you're not going to get there by distributing a really good way to search paper documents or a really good way to call a traditional taxi. You need to change the price of the thing itself. And so the trick is, how do you get the manufacturing bit to be actually zero, the cost of manufacturing to be zero, not the cost of distribution, but the manufacturing to be zero. So if you look at Google, it grew up on the internet and the content that accrued to the internet. To generate content on the web costs you nothing, right? Well, not zero, but the limit approaches zero. So you're generating this content, and then you have millions and millions of pages. The entire industry of media and content generation for print goes to zero manufacturing costs, human time. What's that worth? And you see the number of websites go up exponentially. And what Google did is they sat on top of it. They rode $0 manufacturing for content. And then on the chart on the right, what you see is advertising revenue, and the bit in yellow is digital advertising revenue, so 40% of the entire market. You can just basically see it, eat away at the whole industry. So the gating, or the layer on top, came after that fundamental shift in the manufacturing side, not before. Similar, music. So I used to tell this story as like the cost of music distribution. I actually think it's the manufacturing of the copy-paste of the MP3, the copy-paste of the movie file. And you see the exact same story play out. Once the actual manufacturing of the content, after you're done with your fixed costs, went to zero, you've got your Napster user growth on one side. The other side tells you the same story as before, which is massive collapse in industry revenue, and then the remainder is digital. So that little yellow bit, that's streaming, that's Spotify. You can't build Spotify on disks. Doesn't make any sense. You can build Spotify on freely manufactured music. Note that it took 15 years. Same thing for Uber. This one's fun. Takes a little bit of time to figure out what went to zero. So on the left, you have the price of a license to provide transportation, right? That's the actual, the city gives you the license to operate a cab. So it's the price of transportation. The artificially created price of transportation was $1 million. So if you want to be a cab driver, you borrow $1 million from the taxi lending company. So you're like an indentured servant for the rest of your life, trying to pay off that loan. And you get the transportation ticket, now you can ride around. And then Uber comes along and they say, you don't need the taxi medallion, the $1 million of cost. You can just do it for free because we arb the regulation, we position you in a different way, we put GPS on, so all these things come together to create a substitute good for that cost of transportation. The cost of transportation is zero. The cost of providing transportation goes to zero, outside of the fixed cost of the car and the human. And you can see the price of the medallion like just literally drop 80%. And again, the chart on the other side is growth, Uber penetration in cities. And again, once that happens, once the manufacturing cost of the thing disappears, now you can build platforms and things of that nature on top. So to me, this is a core insight. And I think blockchain-based networks and financial services are the answer to this question. They are the manufacturing chassis for all financial instruments. You are all converts because you're here, so I won't read these bullets. But the core is you have digital scarcity around goods. That is unique and novel and amazing. It's fundamentally amazing. You have out-of-the-box features that are mind-bogglingly expensive. So you can get $1 billion in cybersecurity costs, i.e. mining, for free if you're using Ethereum. You have thousands of developers writing code on your behalf for free if you're using blockchain-based financial instruments. Obviously, there's lots of stuff you can do with tokenomics and other primitives that everybody here is building. Again, not something that's easily replicable or really available before. And then finally, a whole bunch of blockchain stuff maps on really well to what finance needs to function. So the fact that I think it's a magnificent chassis, essentially, for the future manufacturing of financial instruments in finance. I'm probably taking up a lot of time, but I'm enjoying myself, so I think that's what matters. That's really, it's all about it. It's all about me. Okay, so this slide, we go back to this kind of point about behaving ourselves well and playing with others who have different points of view, who might be more conservative or more risk-seeking and come from different disciplines. So I kind of want to anchor this in how I think we'll develop good DeFi protocols that are adopted by a lot of people. And so on the bottom, you've got, again, the thing I've been saying over and over again, which is the payments to insurance, banking, lending, that continuum. And then vertically, what you have is the crypto maturity curve. Doesn't look very curved. It's slightly curved. I blame my presentation software. And the way that the curve goes is that you start getting people onto similar standards around their data. Like, we're not even there. If you talk to most large financial incumbents, the issue they have is they can't get onto cloud, right? Like, their issue is a 2004 issue, not a 2019 issue. So getting them to have data and standards they agree on is the very first step. The second step is to start putting workflows on top of those standards, right? So you can do things in a mutual way. You don't recreate rebalancing 10,000 times, or financial planning, or money movement. You have a standard and you have a workflow. Then once you have a workflow, let's have a token. Let's put something from the real world into the blockchain network. And at first, you put just a little bit in there. You put like 1%, right? So the token, like an ICO token, ooh, okay. just take a pause. Okay, so you got a token, and all it does, it's a hyperlink to the real world, right? So it says, I represent all these legal agreements, which represent companies and other activities, et cetera, right? So a little bit of information in the token. And then over time, you can put more and more information in the token. So not 1%, but 5%. Now my token does dividends and has a little bit of voting in it. And then you go from 5% to 20%, and from 20% to more and more and more, until you put all the software that used to live around the financial instrument into the financial instrument, right? So, and then you get your DAO and your protocol that issues the actual stuff. And so to me, we've got to respect people's activity along these different levels of crypto maturity, because they're all driving in the same place. If I had to use the picture of the boiling pot, I would say steam rises, right? So even if you're doing enterprise blockchain, the end effect is the same, which is you're getting tons and tons of people to understand and come closer and closer to what we really want to happen. Bless you. Okay, last bit, DeFi bit. How many people have read the Cryptonomicon? Hiss boo. Okay, like 10%. Go read the Cryptonomicon. It'll take you 4 years, but on the other side of it, you'll be able to raise your hand in a college hall. Okay, it's spectacular. It's a really great book. It's really long, like really long. And if you have children, you never have time to read it, and then you don't remember what you read. Anyway, Cryptonomicon tells the story of Bitcoin. Not true at all. Cryptonomicon essentially is an imagining of a world where people are putting together Bitcoin on a very different sort of time horizon and approach, but it's a prophecy. And it was written in 1999, and it is eerily interesting in terms of the social issues it highlights. I've only found one DeFi prophecy, and it's this book called Accelerando by Charles Strauss. Has anyone read it at all? Awesome. You guys are the best. Friends forever. Okay, so 6 people and me, 7, read that book. And I think it's a spectacular book. And what it does is it walks us from 2005, when it was written, into the singularity in 2030, and through the singularity into 2060 or 2080, ending in a Dyson sphere around the sun full of AIs and corporations, and everything's been melted down into atomic nano goo. And everything's like flying in a light sail to other galaxies. So it's a great book. And in it, there is a moment, which I'll never forget because I think it's happening, when AIs start using legal corporate wrappers to instantiate themselves. And then once they're able to do that, they start spitting out thousands of other corporate AIs all over the world. And then they start having kind of capitalism. I think it's called capitalism 1.0, which is what we humans do. And then after a while, I think around the time the Dyson sphere is being built around the sun, they launch capitalism 2.0. And it's not good for people, I'll tell you that. So I do feel like we're in this place where we're starting to build the transition from capitalism 1.0 to 2.0. And so go read Accelerando. You will see this chart, I'm sure, from other speakers. There's been, and it doesn't actually have everybody that's here or everybody that's working in the space, courtesy of the block. People are building companies across the industries that I've mentioned. They're building protocols, they're building distribution pieces. And the way I think about them, the examples here are lending DAOs, DEXs. I think token offerings are kind of investment banking DAOs, essentially, whether they're IEOs, STOs, or whatever. So you have examples of DAOs building different financial product, manufacturing different financial product. So it goes back to that kind of core thesis of who's going to make the thing and what is the cost. So to me, this demonstrates the starting shift into a different version of manufacturing financial product at a zero cost. And kind of one word of warning is that we're all excited about the growth, and in DeFi lending in particular, DeFi lending is going faster than digital lending. So this is the first 3 years of digital lenders, 2007 and on, Lending Club and others. And then it's the DeFi lending volumes as well. So we're growing faster, but a word of warning for people about getting super excited. ICOs grew faster than blockchain venture capital, right? So what we need to think about is how do we preempt what happened to the other financial DAOs? Because all of them broke. All of them, each and every one, right? We haven't in DeFi land yet. And I think part of the answer is really embracing regulation, getting ahead of it. You know if you're running a DeFi lending protocol that you're a bank and a lender. You know it today. It's in your heart. You know it. It's true. I'm like preaching now. So get ahead of it. Figure out your regulatory strategy before it undermines the ability for you to deliver, even though you have operating progress, which no question you do. The other thing I kind of worry about is there's this really interesting stacking effect, and people are excited about derivatives on DeFi protocols. So we can take financial primitives, remix them, slice them up. We take the interest from this thing, and then we attach it to this thing. And we create all sorts of new exposures. So this like financialization of what we're doing with the core manufactured financial product. And the reason I'm going on about that is remember your customer. The things that will sell are things people will buy. And kind of over-financialization of what we're building really narrows down what people need. So start again with a customer. And I bring this example up because I think it's stayed with me for about a decade now. And it's this question of how do people invest? Like, what is a regular, normal human being who doesn't want like isolated, interest rate, DeFi, margin lending exposure, levered up 100 times? What is like not that person? What do they want? That's the one's super clear as an explanation of a customer type. But I think you get it. And the answer is they just want to, in their world, finance is 20% of economic activity. They don't want to think about finance all the time. They don't want to lose money. They don't want to feel bad. And so one answer is help them achieve their financial goals, help them flourish, give them safety, and provide an answer. So how have people done this in the past? They've done it with an asset allocation. People know what an asset allocation is? It's a pie chart with assets in it. You can get it on the internet. It's free. Go on a forum. OK, so in 2003, if you wanted an asset allocation, you need $2 million. You go to Goldman Sachs. Goldman Sachs sits down with you, spends 3 weeks to put this together. They give you a pie chart. In it are equities, bonds, fixed income, commodities, real estate, all of this together. You pay them 1.5% for the privilege. You fast forward 10 years, you're in 2013. You want a pie chart. You go to Betterment or Nutmeg or any other one, and you give them $5,000, and they take that and they make it out of ETFs, and it's got 15 asset classes, and it's got equities and fixed income and commodities and real estate, right, where we are today. And you pay them 25 basis points for it. Good improvement. Where I want to be in 2023, 10 years further, is you've got a quarter. Bitcoin quarter, Gemini quarter, PBOC, Chinese quarter, whatever it is. You want to take that, and you want a pie chart. And you want to put fixed income and equities and venture and real estate and commodities and all this stuff in it. And you can do it in 25 cents. And on top of that, all of the software that used to sit around that asset allocation, rebalancing, set protocol, asset management, Melonport, et cetera. All the financial planning, so this retirement glide path would change your asset allocation over time as you spend or you get older, whatever it is. So the software that used to do that now sits in the quarter itself. It's in the DAO that manufactures the thing. So you can see a real example of how somebody's life can be improved by holding that type of financial instrument. So I'm going to wrap up. I'm going to wrap up. I've got 2 slides. And then I'll stop enjoying myself talking. So those are all the types of products that you are working on and can build. But remember the FinTech journey and the financial incumbent journey and the fight that they're having. And they will not let you sit still, right? So you've got an opportunity, and today things like InstaDApp, which aggregate all this stuff together and function really well and are beautifully designed software, they're awesome and unique. And so we've got a little bit of time. But you go to Coinbase already, which I imagine is a little more conservative or a little less risk-seeking than the core DeFi folks. Coinbase today is certainly going into this area, right? So they've already got a dApp wallet. 6 months, 18 months, it's over, it's done. Move one step further, and you get to Square and Square Cash, right? So Square's got, I'm going to make this up, 5 million users, give or take, who are actually using the thing for payments every single day. They've got a card, they have bank accounts. You can trade Bitcoin there today. No reason why that's not going to also incorporate all the DeFi protocols. And then you get into the real world with merchants and so on, and then you start going into Visa and MasterCard and First Data and Fiserv and Temenos and the rest. So we don't have that much time, and we've got to get it right. I feel like that's my clock. That's the end. That's like, and then just shots fired. OK. So the very last bit I want to leave you with is thinking about who will win in this world. And you've got 3 options in my mind. You've got the Terminator, which is a fully AI-based system, right? So your financial advisor could be just fully software built by Ant or Google or Amazon, whoever you think. And so that is a software system alone. Number 2 is you can have large banks, JP Morgans and Goldmans, who lop off a human arm and attach the software arm, right? The bit that is digital transformation or innovation. And so they're going to be at the party as well. And then finally, I was like looking for a good decentralized one. And who knows Locutus of the Borg? Anybody? Or am I too niche? OK, 3 people. This Star Trek reference. Who knows the Borg? Just as a, OK, we're a little bit better. You're now all part of it. So in this world, you have open software, best practices incorporated into sort of self-sovereign individuals, right? So any of these things, they've all already been imagined, and I'm super excited to see where we come out on the other side. Thank you so much. Last bit, we're going to do a consensus announcement of Ethereal. If you're going to be there, I forgot to promote our own stuff. But we're obviously working in the space, and in a week or so, we'll be public with it as well. Thank you.